Welcome to Mortgage Wise with Mike Wise at Capstone Direct. I'm Mike Wise, and today we're going to be talking about buying a house and what goes into it. So whether you're a first-time home buyer and buying a house for the first time, or this is your second or third purchase, this will kind of help you determine, the steps or what you need to look at or what we look at when you're going to buy a house. So a couple of things that we're going to talk about is credit, income, down payment, and closing costs. So let me take a deeper dive into each one of those and help you kind of understand some of those items a little bit more in detail. Credit. Credit is, we look at Experian, TransUnion, and Equifax. Those are the three repositories that everybody reports to on your credit. So your credit is made up of, your credit scores are made up of all the different credit that you've received in your lifetime. And so it's gonna show your Target card, your car payments, your house payment, if you have a house payment, any installment loans, anything that's reported to TransUnion, Equifax, or Experian, it's going to show on your credit report. And what we look at is a couple of things. One is your credit scores. And so I'll go into a little bit more detail on that later, but your credit scores and then your history of your credit. So how have you paid your credit over time? Because what we do is we look at your past history to see how that's going to predict your future payments on your mortgage. So if you've paid your bills on time, you're probably going to pay your mortgage on time. If you've paid all of your credit in a timely fashion, you're going to pay your mortgage in a timely fashion. Let's go into the credit scores. The credit scores are made up of all of those credits, that credit that you have. And it's going to determine a couple of things. One is how much usage do you have on that credit? So if you have a $1,000 limit on a credit card and you're maxed out every single month and it may be going over because you're just making the minimum payment and you're using it still, your score is gonna go down. Whereas if you're paying it month to month, you're paying it and you're keeping that balance below 50% of the available credit, so $500 in this example, you're gonna see an improvement in your credit scores. So they don't wanna see you have this available credit and actually maxing it out every single month. They wanna see that you're using it properly and paying it on time each and every month. So all of those things have a huge impact on your credit scores. And in turn, that will have an impact on the rate that you pay on your mortgage. So for instance, on a $500,000 loan, you may pay 0.5% more if your credit scores are lower than if they were 740 or higher, 740 scores or higher. And so 0.5% over 10 years is gonna be $20,000 in interest extra that you're paying because you don't make your credit payments on time or you have lower scores. So that's credit. The next thing I'm gonna talk about is income. Income is, we're looking for a 2-year job history and a stable 2-year job history. And that's if it's full-time, part-time, self-employed, or salaried, we're gonna look at that 2-year history. The 2-year history is gonna tell us kind of the income that you've made, and it's gonna predict what you're gonna be making in the future as well. And so let's go to a W-2 wage earner. So you work for somebody and you get paid a salary. That salary is $60,000 a year. We're gonna take that $60,000 and divide it by 12, and you get $5,000 a month for your income. And that's where we're gonna start your income at. Same for anybody that has a W-2 job. Now, if you have bonus, commission, or overtime, then we're gonna actually have to average that income over 2 years. So we're gonna take your bonus and your commissions over a 2-year period, and we're gonna add that up, divide it by 24, and that's the amount of income that we'll be able to give you for your particular situation. Same thing goes with part-time income. We average it over 2 years. Because your income fluctuates, it's really hard to determine what your actual pay is on a part-time job because your hours are different. So we're going to actually contact your employer and make sure that we get a good 2-year history of your income and average it over that 24 months that I talked about. Self-employed gets a little bit deeper and a little bit more complicated than a W-2 wage earner. So for that, we need 2 years worth of tax returns. The 2 years worth of tax returns will tell us what your income has been and how much we can use to calculate your income. So we're gonna average that over the 24 months as well, but we're gonna need your 2 years worth of tax returns, both business and personal, any K-1s or all of your tax documents that you submit to the federal, for your federal income taxes. Down payment. There's a couple of different things that people think about on a down payment. You may have actually talked to your parents about a down payment and they say, oh, you need 20% for a down payment. That's not the case anymore. These days, we can do 3% down, 3.5% down, and it's not so bad. Even though you're putting less than 20% down, you will have to pay mortgage insurance. But in those instances, it might make sense to get a house versus not getting a house. And you have an investment at that point in time where your mortgage payment is gonna stay the same for a long time, where if you're renting, you may see that rental payment go up over time. So sometimes it makes sense to buy a house with the minimal money that you do have right now and get into that house. Let's talk about the seasoning of those gift funds or of those down payments. So you can come in with your down payment, which you have to have seasoned for 60 days, or you can get a gift from a family member, and that does not have to be seasoned. We have ways to kind of work through that and manage so it does not have to be seasoned. So even if you don't have the money for a down payment, your long lost uncle may be able to gift you that money for the down payment so that you can get into the house and make those monthly payments. Closing costs. Closing costs are, you should budget for an extra $5,000 to $10,000 in closing costs when you actually close on your transaction. So let's say, for instance, you're buying a $500,000 house and you're putting 20% down. That's $100,000 for the down payment. You should say, I need $105,000 to $110,000 in order to close that transaction. The reason I say that, these are not all actual costs, but it is funds to close, cash to close. And that cash to close includes prorated property taxes. So from the day you own that property to the end of the tax period, you're gonna actually owe taxes, property taxes. There's gonna be escrow and title fees. And if you want to go into a little bit more detail on escrow, we have some other videos on escrow and title that you may want to look at. There's an appraisal fee, there's inspection fees, there's all sorts of fees that are going to be included in this whole transaction that you might not think about that you're going to need to come up with in order to close your transaction. And when we get you pre-approved, we're going to be looking at those things to make sure that you have enough money to close on a transaction. So those are the things that we're talking about as far as buying a house and what it entails. So this is Mortgage Wise with Mike Wise at Capstone Direct. And you can go to our website, you can go to some of our blogs and see if there's more information that you want to learn about. But thanks for tuning in and hopefully we'll see you next time.